Hello and welcome to KYC. I am Sharad Dubey and the company on KYC's radar today is our Speciality Restaurants. News flows also coming in from this counter and the numbers also in Q2 were largely, you could say, on the mixed side, but there was some positivity as well. Now, as we head into the festive season, of course, we're expecting that there would be strong demand kicking in. But in this question, why have we got this company? This is a company having a low float, you could say, and the volumes are low, market cap is low. But what is the special thing about this which all the investors want to know? This is what's the rationale for the new development of a leasehold land in West Bengal. When I speak about specialty restaurants, it's a restaurant related business. Then why this announcement is coming in? That is something which we'll be asking. Second question on our radar in KYC would be, why has the SSG guidance been raised? Of course, the third quarter and fourth quarter are expected to be stronger in the restaurant industry, and that's by definition it comes. The third question we'll be asking is, what's the share of dine-in versus delivery? Is delivery also gathering pace? Are people ordering good food from their brands also directly to their homes? That's something we'll be watching out for. Operationally, the margins guidance ahead, that is very important. There was a good operational margin uptick in the second quarter, but will that sustain? And also the fifth question is the restaurant opening and capex targets in next 12 months. It seems like the company wants to expand very fast, and when the expansion kicks in, of course, the financials also do take a hit. But yes, the revenue potential goes up. So these are the key reasons actually about this company. And this is in the business of operating restaurants and outlets, and sweet shops are also there. And I'll tell you the brand also, which is very much important, especially in the Western India. They operate in fine dining as well as the casual dining space, resto bar, cloud kitchens and confectionaries. You see the entire gamut of services are coming in from specialty restaurants. You must be wondering which are the brands. And we had earlier teased also in social media. This include Mainland China, O Calcutta, Asia Kitchen, Sweet Bengal, that's the confectionery one, and also Global Grill. This brand is called Sigri as well. Bizarre Asia, Jungle Safari, Cafe Mezuna and Riyasa. These are the new names which have come up over the last 3 to 4 odd years. Haka episode 1 also come in. These are your household names whenever you travel outside or order in food. So that is why you must be wondering why these companies are coming back again and again. So the company, the main holding company is called Specialty Restaurants. This was incorporated in 1999 and these are the two classic brands. It started from one restaurant in the city of Kolkata. Specialty Restaurant in 2025, see the journey. They have been profitable for consecutive 17 quarters till Q2 FY26. Look at the network. From one restaurant, this has gone up to 123 overall restaurants, confectionaries and franchisees. Of course, most of them are company owned, but some are there on the lease as well. Let's see the outlet synopsis, how actually things pan out. And I was just mentioning earlier, 112 of them are still the owned unit side, but the franchise unit, that's just 11. That means company focuses much more on their ingredients, on their entire setup, processes, everything is seen by the company. And that's why, if you see from a customer point of view, there is a good quality control as well. Dine-in and delivery, that's where the question arises with the management also. Till now, it's a 76% coming in revenue from dine-in, but look at delivery, it has been growing, and over the last 2 to 3 years, the way delivery space has gone up even for the casual dining food orders which come in. So that's why delivery segment is also becoming important for the company. They recently signed pact with coal mines associated traders also, and you must be wondering why this is happening. This is due to a development of a leasehold land in West Bengal as well. Company has a multiple business areas as well, and maybe there might be some synergies because of their core strength coming in, and this is a large land parcel in West Bengal as well. So these are the key takeaways coming in when you understand where the company is standing. But remember, the market cap is on the lower side and the institutional interest is not so much there in the stock, but we'll decode everything regarding this. But our show has 8 parameters when we judge a company in KYC. I'll list you down all these 8 parameters, and these are very much important. Income statement, balance sheet, cash flow, these are the holy grail of fundamental analysis. We take them first. Then comes the return ratios, what the ROCs and ROEs have meant to the stakeholders. That's one of the best questions to ask. Apart from this, looking at the street cred, valuations and outlook, and of course the shareholding. These are the other parameters we'll be judging. There will be roughly 8 parameters, and then the KYC rating would come. So let's move on. income statement, the first and the most important numbers looking at them, the revenue, there has been a significant jump if you compare that with FY24 and FY25. EBITDA has been largely flattish, not much to look at, but margins, will it come back to the 20%? Or of course, there were some adjustments coming in because when a company starts expanding, their margins do take a hit. So that is something which we will ask the management as well. Our net profit, if you compare it with FY23, it's still on the muted levels. Interestingly, let's pull out the Q2 numbers and see what has actually happened, because I'm getting a very mixed kind of a signal from this analysis. Nothing much actually, but look at the revenues year-on-year basis. The revenue EBITDA, that has done well in the Q2 numbers, and the margins, a slight uptick also coming in, and net profit also a jump coming in. So year-on-year basis, the way the restaurant business pans out, that is still strong, and the margin trajectory, nothing to look at much. There was an aberration 20.5%, but it has remained constant over the last 5 to 6 years. Whether this is good for the industry or bad, that is something we'll ask the management, but nothing much happening, 17.5% in the overall setup. But net, the margin trajectory seems stable. So largely, I would be giving a neutral rating when it comes to the income statement. Nothing very out of the box and nothing really bad as well. So that is the first rating where we come in. Second rating is the balance sheet. What happens in the balance sheet? The equity numbers, they are largely decent enough. Borrowings, they have spiked up, and this is a reason because of the expansion which the company wants to do in the next 12 odd months. Cash bank balance, nothing much to look at because it's a very working capital intensive business when you're entering the restaurant space. So only a couple of parameters, something I'll be judging the company on, and for that, I'll again give a neutral rating for the balance sheet. Cash flow, third one, but it's very important, especially in the restaurant business. Catering is also involved in this. Operating cash flow is decent, jump 73 odd crore rupees, and the cash flow to PAT conversion, that has also been decent. The net cash flows, these are very smaller numbers to look at, but net, I would still give a neutral rating. So nothing bad has happened, nothing great also has happened. Now the first three ratings which I have given you, but the return ratio, that's where the performance starts coming down for the stock. I was just seeing the numbers which we had got. FY23 seems like a watershed year when it comes to the returns. After that, single digit numbers, FY24, FY25, and ROCs, when you enter a stock, you should get something above 15% to 20%, then it makes sense. So that is where the company is lacking. That these are the ROC numbers on your screen, and also the ROE numbers. That has been a problem and cause of concern, and that concern of course is reflected in the share price also. So from my side, I will be giving a thumbs down in this parameter. 4 parameters done, we move on to the 5th parameter. That is the shareholding parameter, and shareholding pattern, just look at the screen, it looks like a flat line, nothing much happening. Promoters having the stake of 50 odd %, but almost minimal exposure when it comes to the institutions. FIs, very limited, 0.2%, it went to 0.5%, so this doesn't move the needle. DIs also, actually they have been decreasing their stock, but it was a very small proportion as well. So the stock has not caught attention of the institutions as well, and a majority of them are in the retail space, the public space. So that also becomes a concern, because if institutional participation doesn't come in, that means major corporate actions or even demand supply might be impacted, and that is why you see the stock always remains in a very small range. There is never a big spike or a big loss. It's in a very small range, and it's been a long-term chart. So net for this, I will be giving you a neutral impact rating. Street cred would be our next one. Nothing much to the shareholders. Last 1 month, it's down 10%. 6 months, nothing happening. It's down 5%. Year to date, down 12%. As I was saying you, the company has not rewarded the medium-term shareholder investors. But 5-year basis, yes, it has been a multi-bagger, 222%. So both sides, confliction views come in. So I'll be giving you, I'll be giving the company a neutral rating. Also looking at the valuations much, the trailing 12-month P, that stands at roughly 29 times. And just to put in perspective, the QSRs, they are on the higher side. That range is between 30 to 50 plus. That's on a blended basis. So net, it is cheaper compared to its peer, but it's not commanding the valuations because of the reasons which I pointed out, especially the lower return ratios, and that is why the market has given it muted valuations, and that's coming in at 29 times. So it's a neutral coming in from there as well. But outlook is something which is very upbeat, and that caught my eyes as well. After a lot of quarters, some forward-looking good statements started coming from company, and I read that the most important thing is management has lifted the SSSG growth from 2.5% to 5%. That means they are coming back. Now, this is of course the industry impact, also the competition coming in, but now they want to say that yes, we are expanding. What are the new formats they are targeting? 2,500 to 2,700 square foot area, and the capex that would be roughly 6 to 7 crore annual revenue per store. So numbers are starting to come in, and when the company starts quantifying their guidance, that is where they become sure if they can achieve it or not. So technically, when you study these guidelines, this seems like the company knows their numbers. Also, the company is planning to open 8 to 10 restaurants in the next 12 months. Which category would it be, under which brand, which new geographies? That's something we'll be watching out for. And of course, company has some exposure in the Dubai markets as well as London markets of signature Indian restaurants as there as well, but nothing much major contributor when it comes to the overall revenues. But let's rate the company. Let's rate what's special in specialty restaurants, or is it? First and foremost are the financial numbers. Nothing much happening for the company, and that is why I've given all the first three parameters just a neutral rating. Return ratios, that has taken a lot of toll on the long-term investors, so it's a negative for that. Shareholding, street cred, and even valuations, not much happening here. Valuations are still cheaper than the QSR players, but street cred, only the long-term investor has got good returns. Apart from that, investors' patience has been tested. And outlook, however, I'm very bullish on it because of the growth aspect. So net, I've given 4 out of 8 when it comes to the overall KYC ratings. And historically, these are the numbers on the lower side when we give a company in our show. So this is what the entire picture for specialty restaurants. But to get in us more pictures and to add more spice and flavor to this conversation in our show, they have posted a steady quarter, the company, and with the EBITDA up over 5% and the margins, they are largely stable. Profit growth, however, has remained muted. But my colleague Mahima spoke to Anjan Chatterjee, and he's a chairman and managing director at Specialty Restaurants, and they spoke about the important developments. Have a look.
What is the strategic intent behind signing this pact with Coal Mines Association traders? What is the idea behind the whole acquisition?
See, this is not an acquisition. Government of West Bengal had given us a space to develop a catering college and a commercial complex for our own retail consumption. And on the basis of that, we've been trying to talk to a lot of people in the sense in our joint venture, like we've done it earlier in Salt Lake, and we've also done it in Rajarhat. So we actually started talking to many people, and eventually we saw a lot of synergy between us and coal mine associates. And based on that, we have developed a joint venture wherein they will put all the money and develop the whole plot on a commercial basis. And we will have a part which will come as a real estate to us as retail and space where we can do restaurants and banqueting. So there's no expenditure that we have to do. Based on the land that we have a joint venture, and we get a portion of the retail space created.
Understood. So then how is the revenue sharing model going to be like?
So specifically, we are working on the details of how much real estate will come out of that. The calculations have been outlined, but we would say that we would get in and around because this land is been lying for a long time because there were not too many takers in the city like Durgapur. But now Durgapur is actually coming up. It's a place where a lot of commercial developments have been happening. So hence the part that we will get will be on banqueting, either a ground on the first floor, and we will do all our restaurants. We had done a restaurant long ago in Durgapur, which was earlier than we should have gone there. Now we are planning to do a kind of a haka. We are going to be doing another Walters, the burger, and maybe not just a fine dining, we'll do a casual fine.
Understood. You said the investment part is going to be handled by Coal Mines Association right now.
Yes, please.
In terms of the timeline, though the investment is from their side, what is the timeline looking like post investment development, and when does this kick start?
It is dependent on the regularity or authorities. The authorities have to give us permission to do that. The drawings have to come, and it takes a little time. So we are looking at in and around 3 years. By the time it will be fully ready for occupation.
Okay, and what is the ratio of JV? How is that being determined, or those details are still pending to be penciled out?
Yeah, there are some discussions which have gone in. So because to fix it, nail it, we are in the process of doing that.
Okay, and since I understand that there's no capital going to be involved, this is not going to impact your overall return on capital, but in terms of margins, is it going to be any different from what you're doing right now? How does this impact your financials?
See, I'll tell you very honestly, when you have your own real estate, because there's a huge real estate play here, and as you know, real estate continues to be around 15 to 20% of the total expenditure that we do in any store matrix. So when you have your own places, your own area, you're not paying for the real estate in the form of a rent. So that actually completely changes the scenario of a store matrix. So whichever we do, that it's a self-created and rented place, which is internal rental, which is not to be actually given to any outsource. So that much of margin becomes better.
Mr. Chatterjee, with regards to how Q2 has fared, the same-store sales growth was positive this quarter. The guidance that you've given is that it should be anywhere between 2.5 to 5%. Do you think that is possible in FY26? By the end of FY26, do you think that 5% SSG is possible for you?
As you know, I'm not supposed to give you any projections, but the way things are going, I think that, our stores are maturing, SSG is better. I can also say this to you because OND being the best quarter, we are seeing a lot of traction, we are seeing a lot of tailwind. And you have the best October, November, December, as you know, historically has been the best. And I think that we are looking at a kind of a margin in and around that.
Mr. Chatterjee, the other aspect is a lot of companies that run these QSRs. The trend that I've seen is that because online sales for them is picking up, they are adding restaurants. It's not like they're not adding outlets, but for them, square feet is being reduced, and that's something that you're also following. So for you, that revenue per square feet metric will go up since your square feet is coming down. How are you viewing that metric, first thing? And secondly, in terms of the overall target with regards to where the revenue per square feet stands, what is that target looking like?
See, I am saying that there's not been... One thing I can tell you that we have learned over a period of time that restaurants have to be compressed. They have to be less in space because that's very expensive. So what we are also doing that within the kitchen, as you know, during pandemic, we learned a lot. We were not a delivery oriented company. We were more in dine-in company. So this particular thing, the growth of the kitchen actually being utilized for more than one brand has given us a huge leverage. This leverage is being used in every planning, and all restaurants that we are doing. For example, we're doing one in Delhi. So oriental space is the one which we want to dominate. So from a mainland China, then you have the Hakka, then you have Gong. So this is where we are going to be growing. So within that, like in a place like mainland China, we have a Hakka. We also have a Gong. We have an Asia Kitchen in the mainland China that we are building on. Within Asia Kitchen, we also have a mainland China and Hakka. So because the cuisine is absolutely same, the number of people who are working are already engaged. There is no real estate cost. So these are the ones which are futuristically going to change a lot of margin. There's going to be a place. The only thing we are paying is the commission and the food cost. So I think that going forward, there will be a lot of traction on profitability from this end.
Understood, and that makes complete sense, right? And just to put that point into perspective, right now your dine-in is around 75% and your delivery is around 25%. Over a period of time, let's say 3 years down the line, how do you see this mix evolving? Because even that is going to impact your margins in a positive way.
Yeah, so I'll tell you what, going forward, see, we were almost 1 or 2% pre-pandemic
Yeah.
because everybody used to come there and take away. Takeaway was the only thing, and we were just hovering around 2-3%. We never were understanding that the delivery will actually disrupt. Pandemic did that. So after that, it's become 24% because I think that this will hover around 27 to 30% going forward. The kind of growth which is happening, the kind of social patterns which are happening, and on my table at home, I will see there are 4 brands which are lying with my children, and they've got one A from here, B from there, and there's an ensemble of restaurants lying on the table. So that is a new trend. So it'll grow more and more. Distances are becoming difficult because from one part to the other, especially in a city like Bombay or Delhi now, things are becoming difficult. So people would rather say that yeah, mangwa lo. But the social, yeah. So there's a gathering happening, there's a match happening, there's people are actually very comfortable getting that. So the mechanism of getting food from outside has also become easier and better. So I think that this will grow.
Yeah, absolutely. This year, FY26, the second half, how many more restaurants are you planning to add? One thing, and what is the kind of capex that you're looking at for this? And overall, the entire capex that you do, will that be via internal accruals, or are you looking to raise some funds or debt? What is the plan like?
See, we are absolutely a debt-free company. I've believed this very, very strongly because I'm a middle-class boy. So I think that you should not go beyond your capacity. Internal accruals continue to be there. We have in and around 160 crores, which is lying in the treasury, and we keep on throwing EBITDA margins growing, or the cash is being thrown in from the business within. So we continue to do that, and internal accruals will fund all our growth. Your question, part A, was to tell you that we will be doing in and around 4 to 5 restaurants. Actually, will be operational in the second half. Now till the 31st of March, because they're all under fit outs, and God willing, we should be absolutely ready by 31st March or max 1st April with 4 to 5 restaurants.
All
Addition.
right. All right, interesting. One last question, Mr. Chatterjee. With regards
Yeah.
to any new brand onboarding, or you launching a new brand, or acquisition of some new brand, anything on cards?
Acquisition, no. At this point of time, acquisition, no, because we are the only company. Speciality is the only company. I'm not flaunting this, but have been able to develop brands within. We're the only company over a period of time. I'm talking, there are many others who have followed and done it in casual and fine dining now. I'm very, very happy about that. But we've not borrowed any expertise to build brand from any international company or anything else, but from the mainland China, Asia Kitchen, whether you talk about Cafe Bazuna, Siciliana now, Walters, my son's doing the burger part, or anything like an O Calcutta or a Sweet Bengal, everything is homegrown. So I don't think there's any need for us to look at an acquisition where people are struggling and we look at the future. We have enough on our plate to develop.
That's an interesting take from Anjanda, that there's enough on the plate. Of course, 2 questions arises. Is it enough for the investors, or is it enough only for the customers? But 3 important takeaways coming in is the West Bengal plot, which is coming in as a retail space in Durgapur. There is no investment coming from the company side. They will be just making a banquet, and some of the brands will be getting introduced in the casual and fine dining space. Q3 generally remains best performing, and in this parlance of restaurants, it's called OND, October, November, December. And the last takeaway is definitely the revenue contribution that's expected to grow going ahead more, especially on the margin front also, because operational efficiency kicks in. They have just a single kitchen and multiple brands can be served. So, of course, management has given a strong outlook going ahead, and Q3 quarter is largely to remain strong over here. So the time will decide whether we see some better numbers coming in the Q3 numbers in the coming 1-2 months or not. But that's all enough for this company, Speciality Restaurants, and thank you very much for tuning in to KYC.